Good afternoon, everyone. Thank you so much for joining us for this NCAP membership webinar, Planning for Your Financial Security, with our endorsed vendor, Mutual of America. This webinar is being recorded, and the recording will be sent along with the PowerPoint slides to all webinar registrants. Today, the Mutual of America team will discuss helpful planning tips and resources for securing your financial future. There will be a question and answer session following the presentation. I do have a couple of updates and reminders before we dig in. So a few upcoming NCAP annual events. The convention is coming up in August. Mutual of America will be there. That's the 27th through the 29th in Detroit. We also have happening in advance of the convention, the Community Action Data Convening, the Weatherization Assistance Program Energy Summit, and the New Executive Directors Institute. We encourage you to investigate those opportunities as you're able and attend as many as you're able to for an informational packed week of training and technical assistance. If you have any questions related to those events or related to your membership here with NCAP, please don't hesitate to reach out to the NCAP team. With that, I'm going to turn it over to our CEO, Denise Harlow, for some opening remarks.
Thank you so much, Jovita. Thank you, everybody, for being with us here today. And I hope to see you all in Detroit. I think it's going to be a great week. If you're a new ED, 5 years or less is kind of where we frame that as. But I've been telling more seasoned EDs, if you need a booster shot, we'll see you in Detroit. So hope that we see you there. I'm really pleased that we're able to bring Mutual of America to the table today in a different kind of way. If you've heard me talk about retirement planning, you know it's something that I'm personally very passionate about. Working in the nonprofit sector for more than 30 years, I don't have a pension, right? I've worked in community action. I've worked for a variety of nonprofits over the years. I have to build my own pension. And the nice thing with today's investment tools and resources is that it can be done. You can have a retirement with dignity while working in the nonprofit sector when you are working in community action. Those of you who are younger on today's webinar, time, as you're going to hear today, is your most precious, precious asset. You can invest less and end up with more than those of us who might be more seasoned in our career, who have less time in the market. And I'm sure they're going to be talking about time in the market is better than trying to time the market. So it may feel nerve-wracking, it may feel risky, but if we need to invest in order to ensure that we keep up with inflation with our savings dollars, I hope that you will consider Mutual of America as your provider of choice. And regardless of what provider you use, I hope that you are focused on your potential future and building a retirement that you can live with dignity after you're finished with your working career. So hope you can tell that I am passionate about this topic. So I'm going to turn this over to Earl Jones. Earl, you've been a great friend to Community Action, a great friend to Community Action Partnership here at the national office. And thank you so much for bringing your team's expertise to today's table and around the country as you table and as you network with our Community Action colleagues from all over the country. I'll turn it over to you.
Thank you, Denise. Certainly a privilege once again to be in your presence and to your leadership team, Jovita, Rebecca, for their assistance in helping us put this on, and to all of the leaders throughout the country. Welcome. Certainly it is a joy for us to kind of bring something to the table with the hopes that it might be a benefit for you. So the webinar is entitled Planning for Your Financial Security, What You Need to Know. And I have certainly a good friend of mine who is a wonderful colleague, Kelly Montgomery. She's the Senior Vice President, Regional Director of our Financial Consulting Services Division. That's a mouthful. She does a lot of great work for our participants, our leaders throughout the country. And I think this is something that's going to be helpful. So just a bit of information prior to just letting Kelly do her thing, but we are grateful for this amazing partnership. And so just want to kind of go through what we're going to be talking about today. First of all, who we are, right? I know that there's a good number of leaders that know who we are, but just a little bit if you're new to who we are as a retirement plan provider. Then we want to talk about briefly our partnership commitment to community action, the purpose of planning, 5 areas of financial planning, and then we're going to give you a to-do list, something that you'll put some skin in the game and get to work on what you've learned. And then we're looking and aiming to have some moment where you can ask your questions, and hopefully we can be of further support to you. The first thing is, I think is important is that who we are. Back in 1945, we were started as a nonprofit to serve nonprofits who are not being supported with respect to having coverage as it relates to Social Security. And for 80 years, we just celebrated our birthday. Actually, this year we're celebrating our company's founding. And we're really focused in on nonprofits. We believe we have an understanding of the challenges, the makeup, and what is important. And we aim to learn to do that as best we can. And in a real sense, it's important for us to convey the message that we are here to serve those who serve. We're over $30 billion company, 97% retention rate. That means when people come to us, they pretty much stick. One, because we're intentional about making sure that we're delivering on our promise. And that's why I make it a point to be at your conferences to make sure that we're present so that that we are committed to making sure that you are getting the services that you deserve. The last thing before I turn it over to Kelly is we are very proud for over 20 years to be the endorsed preferred provider for community action. Particularly now during this challenging season, we want to make sure that you know that you have a friend in Mutual of America. We have 375 CAP clients across the country. That's a little less than $1 billion in assets that we manage. And then that's 28,000 employees that we're very proud of. That just doesn't happen. And I have to give credit to my regional offices across the country. They're doing the work. Back in the days that, they used to say they're making the donuts. And they're the ones that we make sure that they're doing the work with respect to a participant account representative, doing the new hire orientations, being with your participants, and the client relationship managers that's helping you navigate your plans, making sure that it's in compliance, all the things that are necessary to have a successful plan. Ultimately, what Denise was sharing is that we want to make sure that people have better outcomes and positioning themselves for a financially secure future. And with that, I'll turn it over to my colleague, Kelly Montgomery, to take us further as it relates to the purpose of the plan.
Thank you. Thank you for having me. So the the title of this presentation is Planning for Your Financial Security. The key word being planning. A financial plan is just a simple guide for using your money wisely. It helps you to figure out how to save for things that you want, like a house, vacation, retirement, and not run out of money, leaving you feeling more insecure or leaving you feeling more secure. 36% of Americans have a written financial plan. Among those, 75% say it makes them feel more confident about reaching their financial goals. Households with a financial plan are 2.5 times more likely to save enough for retirement. So when it comes time to submit your paperwork to retire, you can do so with confidence. When I consider the purpose of a financial plan, I truly do consider it a roadmap for how to get from where you are right now to the ultimate goal of being able to retire confidently. And it all starts with an honest understanding of where you are right now, where you'd like to be, and all those steps in between to get you there. Earlier, I mentioned saving, for a house or for a vacation. You know, most people spend more time figuring out where they're going to live or where they're going to take vacation than what their retirement is going to look like. The key areas in any financial plan would include those, taxes, estates, investments, retirement, and insurance. So what I'd like to do today is to take time so that we are really paying attention to those key areas and spending the time, a little more time than we would normally spend on, planning a vacation or buying a house or something like that. It is time to actually spend some time thinking about what retirement's going to look like. Next slide, please. So let's start with talking about estates and taxes. Next slide. Your plan should integrate tax planning as a core to optimize your financial resources. I'm going to break down tax planning in both phases, which with specific strategies and considerations. So in the pre-retirement tax planning stage, while you are earning income in a financial plan, it focuses on reducing your taxable income, maximizing your deductions, and leveraging tax-advantaged accounts to build wealth efficiently. Contributing to a 401k or an IRA allow you to make pre-tax contributions, reducing your taxable income in the year you contribute. On the flip side, making after-tax Roth contributions won't reduce your taxable income in the year you contribute, but those distributions in retirement will be tax-free. So having some Roth assets in retirement using a blended approach, meaning having traditional and Roth, can reduce your overall taxes in retirement. Other pre-tax planning ideas include leveraging tax credits, and also some deductions. So such as child tax credits, mortgage interest, charitable donations, and other ways to itemize. Funding HSAs can also be a way to use your retirement and can be used in retirement to pay for medical expenses. Then there's the post-retirement side of tax planning. In retirement, some income typically comes from Social Security and pensions. When I think about income, I'm only considering money that's coming in from an outside source. Most of the time, this income does not cover all of your expenses. This is where retirement savings makes up the difference. One common withdrawal strategy in retirement is to use after-tax dollars first. That keeps you in a lower tax bracket initially. The only drawback is that once you use those after-tax assets, they're exhausted, then after that, you have to utilize your pre-tax dollars, which the beginning of retirement can be very, very low tax, but then towards the end of retirement, you really don't have anywhere to go. So you are generally in a higher tax bracket. I mentioned earlier about that blended approach, contributing to both traditional and Roth assets. This is where that strategy starts to pay off. Withdrawing both traditional and Roth assets at the same time will reduce your taxes longer. It has been my experience that the best strategy is not eliminating taxes for a short period of time. It is reducing tax liability for as long as possible throughout retirement. So let's add another wrinkle to that. And that's knowing when Social Security would get taxed. So you should also be, Social Security would get taxed let's see. So if you have less than $25,000 of other income. So before I was talking about income coming in from outside sources. So this could be Social Security, it could be a pension. Um, any money that's still coming in from an outside source would be what Social Security looks like or looks at. So let's say that that's just that $25,000 is coming in from a traditional retirement plan. So for a person that's filing as or single or less than $32,000 of income for married filing jointly. So let me just say that again. So if you have less than $25,000 of income as a single person or $32,000 as married filing jointly, your Social Security will not get taxed. If you have between $25,000 of other income, but less than 34,000 and you are single, or if you're married filing jointly between 32,000 and 44,000, 50% of your Social Security would get taxed. Or the top range is if you have more than $34,000 of income, if you are single, but more than 44,000 if you are married filing jointly, 85% of your Social Security would get taxed. Knowing these breakpoints and when to incorporate traditional and Roth assets can actually save you a lot of money in taxes in retirement. So at some point in retirement, you will be required to take a minimum distribution. So when that minimum distribution comes, right now the age is 73. If you have been using this blended approach where you are taking some assets from traditional and some from Roth, this is where you should start to see some tax savings because you have been taking pre-tax dollars prior to beginning your minimum distribution. Also, using qualified charitable donations at this stage of retirement will also reduce your tax liability. Next slide. So when it comes to estate plans, are you aware that only 32% of Americans actually have a will? And only 56% of Americans think estate planning is important, but only 33% actually have any type of an estate plan. A simple estate includes a will, durable power of attorney, and a healthcare proxy. So, in a nutshell, what the will does for you is it will look at all of the assets that you have that are outside of retirement plans, life insurance, all of those assets where you actually already have a beneficiary designated. So the will pretty much sweeps up all of those other assets. So this could be the house, the car, just everything else that you would not actually have a beneficiary listed. And it would pretty much say where those assets would need to go. Then there's the durable power of attorney and the healthcare proxy. So these are two documents that if you were to become incapacitated, the durable power of attorney would actually name someone to make financial decisions for you in the event that, again, you're incapacitated. And the healthcare proxy pretty much does the same thing, but this person is now making medical decisions for you. So very important pieces of the estate plan. And typically those three documents, when you have a will drafted, they're all pretty much drafted together. Then obviously another part of the estate plan is the beneficiary designations. So again, in your will or in your retirement plan and in your life insurance, you normally would have to designate who your beneficiaries are. So those beneficiaries, a lot of the time, if you've been working in the same place for an extended period of time, you may not have viewed those beneficiaries in a while. And there may be some other folks that are in your family that you might want to consider. So it's always a good plan to review those beneficiary designations probably once every 3 or 4 years, just to make sure. Not necessary to make changes, but definitely just to make sure that everyone is accounted for that you'd want accounted for. So in addition to just listing a primary beneficiary, there's also the contingents. So when it comes to the contingent beneficiary, this is in case something happens to you and something happens to that primary beneficiary, then you would actually have that backup, the designated contingent beneficiary. And then lastly is this document locator. So I'm going to tell a story. I like to tell stories. Um, I've been in a situation where a person had passed, so someone in my family had passed. And what happened was they ended up leaving a lot of their documentation in very hidden places. And it wasn't for months until that documentation unearthed itself. So for instance, there was a will that was actually hidden in a shoebox in the closet. Um, there was a life insurance policy that was somewhere in a different closet. And so over time, as the house would get cleaned out and things would start getting packed away, that's when these things started, again, becoming unearthed. So this document locator is really just a way for you to list all of those documents that are important for your heirs, because in all honesty, that's not the time when you really want them to have to spend time looking for, well, where's the will? When at the same time when they're trying to grieve. So the document locator is a really important part of the entire plan. It not only will tell them, where the will is located, but it'll also tell them what accounts you have. So not just your Mutual of America, but any other outside accounts. Where do you bank? Who was your doctor? So in case there's anything else that needs to be discovered, any other information, that document locator will actually have a lot of that contact information in there. So another very important piece. So next slide, please. So now let's talk about investments. Next slide. Risk tolerance. Some people can actually handle watching their investments drop by 20% without panicking, while other people would actually stress over a 5% dip. Your emotional comfort is really important when it comes to trying to figure out your risk tolerance, and it's a big part of just handling the uncertainty. So ask yourself, would I sell everything if my investments lost value, or could I wait for them to recover? If you'd like to sell, you might lean more towards a lower risk. So age actually plays an important role in all of this. The older you are, and the closer you get to retirement, generally, the more conservative you become. And this is another area where if you have been invested for a while, you may not have looked at your allocations very frequently. And I have seen where, people who have worked for the same employer for 10, 15 years, they are allocated exactly the same way that they had been allocated before. They really hadn't looked at their overall allocation. What they've done is they may have started contributing from just from their paychecks. They would have changed their future contributions so that their future contributions may be a little more conservative, but the overall picture is still exactly the same. And that looking at that overall investment, looking at those, how you're allocated is really important. And it's will help you when it comes to making decisions about how you should be invested, when you are getting closer to retirement, and then definitely when you're starting to take withdrawals, because your allocation will probably look very different while you're working than when you're retired and taking withdrawals. Answering a risk tolerance questionnaire can go a long way in helping to determine how you should be allocated. Another approach would be to use target date funds, where where those assets within the fund become more conservative over time. Next slide. Insurance is also a key part of the financial plan because it protects you and your money from unexpected events that could derail your financial goals, like accidents, illness, or property damage. Think of it like a safety net. It catches you when life throws you surprises. What and so the types that I will have listed. So just next slide, please. So the types that I have listed here is different types, is what the different types of insurance would cover. So we've got income. So what generally would protect your income, especially when you are working? The type of insurance that would actually protect your income while you're working is disability. But when you're retired, there's another product that actually would protect income when you're retired, and that actually is an annuity. So there is lots of discussion about annuities and annuity products that are honestly very negative. But the way that I look at this, every single product out there has a place. Whether it makes sense for you or not is a completely different story. Annuities do provide one thing that a lot of other products don't provide, and that is an income that you cannot run out of, income for life. So this is a way to create a pension. So Denise was mentioning before that she did not have this, she did not have a pension to fall back on. And an annuity would be a way to create an income for life in place of that pension. So it would be part of the overall picture. So what insurance protects your largest asset? So this is really where I'm talking about your homeowner's insurance. Now, a lot of times, your homeowner's insurance is another place where it does not get revisited very frequently. If you've been living in your home for a while, unless you have refinanced your house recently, more than likely your homeowner's insurance is probably still exactly the same. And if your property values has gone up, a lot of times your homeowner's insurance may not have kept pace with property values. So sometimes it does make sense to take a look at what your homeowner's insurance actually is covering in the event that something should happen, just to make sure that it does cover what you think it's supposed to cover. So asset depletion due to custodial care needs. So this is really long-term care. So long-term care is another one of those products that if you have it, it is a wonderful thing to have, but unlike other forms of insurance, you will get priced out pretty quickly over certain ages. And usually they tell you after age 50 or so, in long-term care insurance no longer is financially, it doesn't financially make sense because the premiums are fairly high. But if you are young, it can make a lot of sense for you, because what that insurance is there for, it is there to cover your, those expenses that you have if you had a need, just to make sure that you don't have to come out of retirement assets to cover those needs and end up depleting those retirement assets. So if you're married and you have a spouse that has a long-term care need, you don't deplete those assets when you still have a spouse that is in good health and could potentially outlive you at that point. So there are some statistics that go along with the long-term care. And usually the biggest the biggest statistic is the majority of oldest daughters are the ones that are usually there to help take care of a parent that has a long-term care need. So that is usually the one thing that those oldest daughters will end up doing, whether it is um, out of obligation or whatever that need is, or whatever that want is. That usually is the case where that oldest daughter is usually there to cover. So when it comes to this long-term care, I generally would suggest at a minimum calling up an insurance agent just to see what the pricing looks like, whether it makes sense for you, because it is there to cover those expenses in case you had a need. Then there is the insurance that would cover for the dependent family. So this, we're talking about life insurance. So life insurance, people can have life insurance, while they're still working, obviously, and when they're retired. I do get a lot of questions about, does it make sense to still have life insurance while I'm retired? Well, that question really does depend on, what did you get that life insurance for? What was the purpose? You got that life insurance for a reason initially. And a lot of times it could have been, I wanted to make sure that the house was covered, the house was paid for in the event that something happened to me. But now you're retired and the house is paid off. Do you still have that need? Well, no, you don't. Well, is there something else that you need to have covered? Well, if there isn't, then you might want to revisit whether there is still a need for that type of insurance. Or let's see, what's the other need is usually like they people will get life insurance to make sure that college education is covered. So that's usually another reason. So if the kids are already out of college, do you still have that need? So there are two types of life insurance that I'm really referring to here. One is term and the other one is whole. There is one that's in the middle, universal, variable, but I'm really going to stick to the whole and the term policies. So term insurance is usually there just to cover a term. It is there short term. It is not there for your whole life. So term insurance is there to cover things like, I just want to make sure that my kids go off to college. So that is not a need that you will have for your whole life. You want to make sure that your house gets paid for. That's also just a term. That is not an expense that you will have for your whole life. But there are expenses that you will have for your whole life, like those final expenses. You want to make sure those things absolutely get covered. You want to make sure that there is cash available um, for those funeral expenses. So if you think about it that way, term coverage, any term coverage that you would need would probably be the larger dollar values, whereas a whole life policy would be a smaller dollar value. But both types of insurance might make sense as part of your overall picture. So I do like to take a look at life insurance when it comes to your overall financial plan. Then there's that uninsured motorist. So there are more and more people who are uninsured these days when it comes to driving. And if you have ever had and you've been in an accident where you have had someone who was uninsured actually hit you, because I've actually had that happen. Um, your insurance, not their insurance, because they don't have any, your insurance would actually cover. So I like to point this out because I think a lot of people will look at this and they will undercut themselves when it comes to this part of their insurance. So you would definitely want to make sure that you have enough uninsured motorist coverage when it comes to your auto coverage. And then lastly is asset depletion above other coverages. So this actually would be an umbrella policy. So umbrella insurance is above and beyond all of those other coverages. So for instance, your largest asset, so your homeowner's insurance, your auto insurance, it would actually give you more insurance above the coverages in those in case you did not have enough coverage in those areas. So umbrella coverage actually is another good insurance to have, just to make sure that you actually do have all of your bases covered. So I like to look at all of the insurances as it's really just a way to make sure that your retirement plan doesn't get sidelined. Because let's face it, if any one of these things happen, generally your largest asset, if it's not your home, then it's your retirement account. Okay. Your largest asset could end up getting depleted because you start looking for places where you can take some money out in order to cover an expense if you don't already have an emergency fund. So all of these areas actually, again, very important. Next slide, please. Retirement planning and budgets. So the retirement plan and budgets are critical components of a retirement plan. As we've been exploring the various areas of financial planning, this piece is the culmination of all the planning that you've already been doing. Depending on, what statistic you've looked at, the median retirement savings for Americans is between $87,000 and $124,000. 39% of US adults have no retirement savings. Mutual of America is committed to helping our participants reach their retirement goals. Next slide. So I always like to start by looking at a budget when I start talking about retirements. Budgets are like four-letter words to people, but budgets really help me determine what my income need is in retirement, because more than likely, I will not want to change my standard of living. Most of the expenses that I have currently, I will have in retirement. So after I create a current budget, which again, all of your current expenses, all of your current income, I like to duplicate that current budget and subtract out any expenses that I have on the current budget, the expenses I have right now that are related to work. And I like to also remove the employment income and add in retirement income to see how much of my retirement income will actually cover all of my expenses. And as I previously stated, income is money coming in from outside sources. So this would be Social Security and pension. So if my income does not cover all of my expenses, then I will need to supplement it with retirement savings. So for example, if I've created a retirement budget and I see that I need $50,000 a year to live, and Social Security, let's say Social Security would only cover my Social Security benefits about 28,000, then I would actually need to withdraw $22,000 a year from my retirement savings. This is where you might start thinking about those taxes. If you recall what I was talking about, married filing jointly. If you were, married filing jointly, and if your other income, so that would be this $22,000. If your other income is over $32,000, your Social Security starts getting taxed. So in this scenario where I've got $50,000 is what I need to live on, $28,000 is coming from Social Security, but I'm actually only withdrawing 22,000, that falls below that threshold. So none of my Social Security would actually get taxed. So all of these things actually do start to work together. And it is important to have in the back of your mind all of these considerations when you're talking about retirement distributions and when you're taking them. The other part of the budget that I'd like to consider is what are those other things that I'm doing in retirement? And roughly how much is it going to cost? Most people do not retire just to stay at home. There are things that you're going to want to do. So this is where vacations, whatever those hobbies are that you like to spend time doing, whatever those things are that you enjoy, the reason why you want to retire, because again, you're not staying home. What are those things that you're going to do? And if, those things again include vacations, roughly how much vacationing are you going to do? Because you're not going to be vacationing 12 months out of the year. So what are those other things that you're going to do? And can you put a dollar value on it? Because you're going to want to add this to your budget. You're going to want to have a sense for roughly how much do I need to include on top of all of those fixed expenses in retirement. So again, what does retirement look like for you? And think of it this way. Every time you walk outside and you get in your car, you are spending money. Even if you're not doing anything, you're still spending money because you've got to put gas in the car. You've got to have the car maintained. So every time you go out of the house, you are going to be spending money. So consider those things that you're going to be doing in retirement, because one other pitfall that I've seen is that people don't really give enough consideration to how they're going to spend their time in retirement. So if you think about the things that you like to do on Saturday, like right now, just the things that you enjoy doing on Saturday, because pretty much every day is Saturday in retirement. Next slide, please. So we have a to-do list. The to-do list here is, it's very simple, but it is designed to get you started. And definitely, it is, it's a way for you to really just start creating your own financial plan. So the first thing that I would tell you to do is to write down what your financial goals are. So there could be some short-term goals in there: buying a house, going on vacation. But one of those goals should definitely be retire comfortably. And what does that look like? And all of that starts with creating a budget. So that's your second to-do list item. So the first, write down your financial goals. The second thing, create your monthly budget. Figure out what those expenses are, and just think about whether or not you'll have those same expenses in retirement. And the next thing that it's very important to do with regard to the overall plan is assess your risk tolerance. Has your risk changed? I know the market has been crazy lately. So a lot of people do find that maybe I am a little more conservative than I thought that I was. But you definitely want to make these decisions before it's too late and the market has done what the market does. So assess your risk tolerance. Create a simple will if you don't already have one. And lastly, schedule an appointment with your local Mutual of America rep. So with that, I think there are some questions that have come through. I hope I have allowed enough time for questions. So whenever whenever you're ready, if you have any questions that you'd like to ask.
And folks, don't be shy. Feel free to drop those questions in the chat. Is there a way, some folks may have personal questions or more personalized or individualized circumstances they have questions about. Is there a
Yeah,
way they
there's my
can?
email.
Okay.
Yeah, there's my email. Yeah, there are, I think I see something. Oh yeah, you want to go back a slide, go back to the to-do list? I can list them again because I generally like to just talk, and I think you kind of got a sense for that. I do a lot of talking when I meet with clients. Um, the to-do list is to write down financial goals, write your financial goals down, have a sense for, what those things are going to be. Create a monthly budget. Budgets are important. I think budgets are usually, they're not things a lot of people like to maintain, but it does force you to look at your expenses honestly. Assess your risk tolerance. Create a simple will if you don't currently have one. And that's kind of it. So when it comes to creating a net worth statement, the net worth is really just a way to figure out, at least on this page, the net worth is a way to figure out where you're starting, what your starting point is. And this is really just a tool that I like to use to track growth. So if you create a net worth at the beginning of your planning experience and you continue to um, add to your retirement savings and you continue to reduce your liabilities, then you will watch your net worth grow over time, and you will want to see that growth. So that's another important piece, is to create a net worth statement. So I'm going to go and take a look through some of the chat here. Earl, if you see anything, by all means.
Yes. Okay, we did that.
Yep, and I am seeing one. We've got a couple of items coming in. Should I have a financial planner? Um,
Everyone should have a financial planner. Everyone should have one. Yes. Everyone
Eh,
should have one. And it's really because, most people, if you think about it this way, a lot of people, they don't do their own taxes. You generally can't create your own will. And when it comes to investments, you will probably have a financial advisor that will help you with your investments. So an investment advisor. The financial planner really just puts all those pieces together. So I think that, financial planning is, because that's the field that I chose. It is a very important piece that can really help fill in a lot of gaps when it comes to, you know, where you are. Um, a financial plan can give you a game plan for, what are those steps that you need to take. But at least with what we've discussed, it does give you a starting point. The budget is honestly the biggest piece of this. It is truly the biggest piece of this, because if you can look at your budget and honestly, ladies, I know when it comes to shoes, that shoe budget, it is really important to make sure that you are putting in, how much you're spending on these areas. Because if you want to live exactly the same way that you've been living, you need to be honest with yourself about where the money is going. So for, whatever the gentleman in the audience, whatever they like to do, um, wherever they like to spend their money, again, just be very honest about where that money is going. Because if you want to maintain your standard of living, you need to have a really good idea what that number is. So if you like to vacation, right now you may be vacationing at one level, but when you're retired, you're going to have a lot more time on your hands. So your vacation budget might need to increase in retirement. So if you like to take one big trip a year, when you're retired, you might like to take two or three. So you will need to include those kinds of numbers. So the budget is by far the most important piece of it, by far, figuring out what that's going to look like. And then from there, looking at your retirement assets and making sure that you are contributing the Roth assets, the before, the after tax dollars, and then the traditional, the pre-tax dollars. Make sure you have some of both of those so that when you actually are retired, you actually have some flexibility when it comes to what your tax picture is going to look like. Very important thing. So I could keep talking. Is there anything? Are there any more
We have another
questions?
question, a couple of more.
Okay.
There's a question that says, how do I know what to place in my retirement plan? If I call the retirement plan company, my job has, uh, uh, retirement plan company my job has, will they help me choose? It's a very good question.
Okay. Okay. So when it comes to your retirement plan, so um, if you are uncomfortable with investing, then the first thing that I would suggest is take a good long look at the target date funds. That's what they're there for. Target date funds are designed to help you allocate and be very broadly diversified in one investment. So it's not a matter of picking this target date fund and that fund over here, this large cap growth fund and that fund. It's one fund. It's one fund and done. So you just pick the target date that is closest to when you are going to retire. And that one target date fund has pretty much everything in it. And that fund will become more conservative over time. That is the easy answer. The more complicated answer is to sit down with someone and to figure out what your allocation needs to be by going through a risk tolerance questionnaire and looking at how much risk you're willing to take and what your overall allocation needs to look like. Should you be more conservative? What that allocation should look like, or if you should be more aggressive, what that allocation would need to look like. If you sat down with and went through a risk tolerance questionnaire to figure that out, your advisor should be able to help you with that. But the easy answer is to start with the target date funds because that's what they're designed for. They are one fund and done. You just pick the one fund and you put 100% of your assets in that one fund because that one fund is a fund that has other funds in it. So for instance, our target date funds, it has large cap in it, large cap growth and value. It has mid cap growth and value, small cap growth and value. It's got some international, it's got bonds, it's got some money market, it's got everything in that one fund. So it has everything in it that you would invest in if you were to do it separately with an investment advisor. Hopefully that helps.
No, that helps a lot tremendously, Kelly. And I want to add to that, in that you asked the question about whether if you call the retirement plan provider, will they help you choose? Well, it depends on the company, but certainly with Mutual of America, there are participant account representatives that are available to sit down with you to educate you, kind of show you the options, as well as more specifically the retirement target date funds that Kelly is talking about. And so, if you don't have Mutual of America, your retirement plan provider should have someone to sit down with you to kind of go over your risk tolerance and things of that nature so that you can feel comfortable and empowered to know what the strategy is going to be. We have another question. It says, what are your thoughts on wills versus trusts? Should both be
Okay.
considered?
Well, it really just depends. So the will, you're pretty much saying these are the people that I want to have my assets, and that's it. You're pretty much done. The assets go to those folks. Whereas a trust is you want to continue making decisions about how those assets are used after you've passed. So this is like beyond the grave. You're still making decisions about how it's used. People will use trusts if they have heirs where they they might be I want to be I want to be as well, let's just say that, you might have heirs that they may not use the money wisely. Let's just put it that way. So in that event, you might want to create a trust that puts some training wheels on the assets that are being used. And it says, you know, something to the effect of, you know, you can use these assets for, you know, for rent. You can use it for food. You can use it for, you know, specific things. But I'm not buying you a brand new car every 3 years. That's not going to happen. So you can still make decisions about how the assets are being used with trusts, where you can't do that with a will. Once the will is read and they have the assets, they can do with those assets whatever they'd like. So it's really just depends on you know, whether you still want to have some level of control over how the assets are used. But it can make, both of those could make sense. It just depends on what your needs are. Any other?
Yeah, I think that's it. But again, I think we have room for one more if there's someone else that would like to ask a question. Okay.
I think I saw something about, so just to further discuss, like there are tools on our website that can help you with some of the easy things. Like if you wanted to get a sense for whether you are currently on track, there are calculators on our website, which I'm sure that those calculators have been shown to you in the past. But this is really where those calculators make a lot of sense when you're trying to come up with something like this. So the calculators can be used to help you figure out right now if the current level of assets that you have, the current level of savings that you have will get you to your goal. So I highly recommend using those calculators. So, any other questions?
And lastly, we do have a smart link that you all can utilize the QR code to be able to download the presentation. I know that the NCAP team has also recorded this as well, so you'll be able to have this for future reference.
Thank you so much, Earl and Kelly, for sharing all of that insightful, informative information about planning for our futures. Um, we hope that we will see you all again. And to you who joined us, we hope you'll join us for another NCAP webinar, whether it's membership related or training and technical assistance related. Hope you have a wonderful rest of your afternoon. Take care.